Hey everyone, welcome to our live broadcast YouTube live Q&A. I'm your host, Dave Keller from StockCharts.com. Normally from Redmond, Washington, today in Duval, Washington, in the eastern suburbs. As with many in the Pacific Northwest, we've been social distancing for a couple weeks now, actually, a pattern that certainly seems to be proliferating around the country. So hope everyone stays safe. Apologies for slow internet here in rural Western Washington, but this is the best we're going to do given the circumstances. I hope the charts still resonate for you as we look at them. The goal with the live Q&A was just give you all a chance to ask any questions on your mind, markets, tickers, things that you'd like to look at a little more deeply. I'm going to start with a couple charts that come to mind as I'm reviewing what's going on as my normal daily process evolves, and then put any questions right in the chat room on YouTube, and we'll get to them in a few minutes if we can. So just looking at the charts, I see a couple things. We had this, severe gap lower this morning. This is after President Trump's statement after the close, obviously yesterday evening. Finishing very low. In the last 20 minutes, we've had a huge spike up, and that's really related to the Fed coming out announcing that they're going to do some, additional repo movements to try to alleviate things. And again, I'm not a macro strategist, but I think these sorts of things like the president's announcement and the Fed announcement this morning end up serving two roles. Number one, it stresses that there's support there, and that a lot of people with ability to help are trying to alleviate the economic challenges we're in. But the problem is, the second thing is, what it does is it confirms for everyone just the severity of the situation we're in. If we're in that bad of shape that the Fed has to jump in and do an emergency repo operation, that tells you that this is a lot more significant than a lot of people have been treating it as. So I think the problem that I'm foreseeing is that the fear that is causing the market to gap down, the fear as the coronavirus issues are things that everyone has to deal with more and more in their day-to-day lives. I think that's what continues to push the market lower. But let's focus on the charts and how the charts are reflecting that fear, that anxiety. So here's the move that we saw down. Here's the gap down from yesterday's close. Here's the overall movements. We were down, and then the gap there is obviously the circuit breakers that we hit again today, that we've hit a couple times now in the last week. The big jump up, and now we've sort of settled back in around 257.50 for the spiders. The daily chart of the S&P doesn't look a whole lot different, and so again, the Fed's move sort of moved us up from 2,500 to where we're at right now. 2,500 is actually a really interesting level. I was talking to my friend Matt Maley from Miller Tabak, is a fantastic technical analyst in his own right. I never use arithmetic scale charts on a long term, so I will not show it to you here. But he shared his chart of the S&P 500 on an arithmetic scale. I always use log scale because I think that's the better way to represent long-term returns. But if you go on a regular scale, it actually is lining up. The 2009 low lines up pretty well with the lows in 2015. Kind of lines up really well with the 2,500 level, which ends up being a key long-term support. We've bounced off of that today, and the question is that enough? The level I was watching after we broke down through 2,700, which was Fibonacci support, also the lows from last spring, is 2,350, and I still feel that's where the next downside objective is going to be. The counterpoint to that is this bullish divergence that I'm seeing with the severe low on that first leg down, and potentially a higher low. But I would caution everyone to say that this move is not over yet. So we have to just sort of see how things are going to play out there. I do want to show just a couple other quick charts, then we'll get to your questions. The next one is from the Mindful Investor Live chart list. I will tell you, the way that I can always tell whether we're in a bear market is if you have to increase your time frame just to get some historical references. Charts are all about looking at where we're at relative to where we've been. But if we're in uncharted territory, pun intended, you have to go back even further. So I'm looking at the AAII ratings, which just came out today, and I'm going back for about 15 years, just to get enough data in here to make sure that I'm able to capture the 2008, 2009 lows. The reason why I'm showing this is for this week, for the first time in a long time, we have over 50% of respondents saying they're bearish instead of bullish. Usually this has been, and in recent weeks, this has been pretty even between bulls and bears. And in that last leg up, it was up to almost 25% more bulls than bears. That's the panel here at the bottom. Now we have 20%, 22% more bears than bulls. And that is not that low because we've been that way in previous corrective patterns, even in the last couple of years. But the fact that over half of the respondents were bearish, that almost happened. It didn't quite happen here at the market low in 2018, really, really close. Before that, you have to go back here to 2013. But the reason why I'm bringing it up is look back here in 2007, 8, and 9. As the market was selling off, you consistently had 50, 60% of respondents being bearish. That has not happened anywhere near that in the longest time. And again, I think that movement, that change in complexion of more bears than bulls, I think is going to line up a little more with that 08, 09 period. It's more what it feels like from a technical perspective from my read. Other than that, this actually doesn't look a lot like 2015. We didn't have that severe negativity, even though the price came down and on a time basis was much deeper of a move than otherwise. The last thing I'll point out, and then to answer your questions, is just looking at the intermarket analysis. I think looking at bonds really helpful right about here. Again, with the actions related to the Fed, the TLT has been fluctuating a ton. If we zoom into just the last year, we're going to see that pretty clearly. So here's the TLT, the big spike up. We saw how it was going up exponentially, pulled back the last couple of days, and it was interesting that both stocks and bonds kind of coming back, but you can see how the TLD has recovered very, very nicely. Sort of got lower earlier in the day, but with the Fed's announcement has kind of rallied up with back up to almost 164 to 165 on the TLT. And I still think a rotation to bonds from stocks makes sense. And I still think gold is one of the better longer term charts that were out here. If you have any questions, put them in the Q&A segment of YouTube. I'm going to go there right now. The market hit the circuit breaker again. What should you do in this situation? So, right. So the circuit breakers are a tough thing, and we haven't dealt with that a lot in recent history. And I'll tell you, and again, there have been periods where that happens a lot more often. The circuit breakers are designed, if you have a big move down early in the day, it'll usually trigger, and that's just a trading halt. Doesn't allow you to do much. And what it's trying to do is just make sure that there's liquidity, make sure that things don't crash. And so it will be very difficult for the market to crash as aggressively. It's almost statistically impossible as it has historically, but it can move down a lot, and the circuit breakers kick in to limit it. What happens there is there's no trading, there's no data. You really just have to pause and wait to see how things react. So two things I would say. Number one, you can guess that the circuit breakers are going to kick in the night before. And what I would encourage you, if you don't look at the overnight futures, make sure that you do that because that's where you will, what I usually do is check the news late at night. That's usually here in the Pacific time zone. That's when Asia, Europe starts to open. You can get some color on what's happening, and you can see the Globex futures in the US. And if the S&P futures are down a lot, you can start to assume whether or not the circuit breakers are going to be hit. And that's what I sort of assumed this morning after the president's announcement. Sort of looked going into bed at what was happening. You sort of saw things were down. You assume that's going to happen. When that does, that just means, I think, as an individual investor, you want to hold off as much as possible and just let things sort of stabilize a little bit. Afterwards, I would say what happens when things kick back in, there's that adjustment period. And so in general, as an individual investor, it can be really choppy there as things sort of get restarted. I've always found it's best to sort of see where the chips fall, see how things kind of play out, see what sort of themes are able to emerge once you get data. From my perspective, technical analysis is all about the data, having good charts to read. Unless you have good price action, it's really hard to do so. So number one, be prepared ahead of time by watching the futures overnight. Number two, wait for things to stabilize and sort of see what movements come out of that reopen, and that can give you a sense about future direction. Seeing no other further questions, all I would say is from long term, I think it's weaker rather than stronger. 2350 S&P is the objective I'm looking for, and overall, it's all about what the price does between now and then to identify some sort of support. The bullish divergence on the RSI is probably number one thing I'd be looking for to suggest any sort of short-term bottom. Haven't seen it yet. For StockCharts.com in Duval, Washington today, I'm your host, Dave Keller. Thanks for joining me on the YouTube live Q&A. Catch my show, The Final Bar, every weekday after the close on StockCharts TV. Just go to StockCharts.com/TV. Have a great day, everyone.